cash every single month for doing nothing. That's what dividend investing is all about. But does it make sense if we see inflation on the horizon? Take a second and pull away from the pundits and the memes and ask yourself, at a fundamental level, what are you doing to protect your investments during inflation? Second thing I need you to do is ask yourself, are your meme and growth stocks getting safer or riskier as inflation picks up? And if you don't have an immediate answer for these questions, then this video was made especially for you. Inflation is coming, inflation is coming. Isn't that what Paul Revere yelled on his midnight ride? Okay, well, maybe not technically accurate, but folks, I do think inflation is coming now. We can debate about it until the cows come home, and we can believe our favorite CNBC investment advisors about inflation being transitory, if we're willing to be risky with our money. Me? I'm not. I'm preparing for inflation to hit me in the face, both in my businesses and my investments. Let's set the memes aside and talk instead about why leaning into dividend-paying companies will get you through inflation. What kind of companies pay out dividends? In a nutshell, companies with stable earnings, stable income, and often below average share price performance. They're not flashy, but you know what is? Cashing dividend checks just for being alive, each and every month. These types of companies pay dividends as part of a, let's say, profit sharing model. You, the investor, are comfortable with that model because you see the value in a company with mature supply chains and consistent customers. So now in 2021, with inflation at levels the United States hasn't experienced in decades, I say it's time for us to lean in to these dividend kings. These aren't startups, these aren't hyper growth plays, just businesses that have been around the block a few times and can handle these changing financial times. Here's a very rough equation for inflation. Raw material cost goes up. Cost to make goods therefore goes up. Margins, or difference between cost to make an item versus what it's sold for, will shrink. Profits shrink. Company's market cap shrinks, and share price accordingly shrinks. Ouch. Investors need to prepare for the pain ahead. Take a look at your investment portfolio. How profitable are the companies you're holding? Can their financial statements and share price withstand the coming inflation? If you want other creative picks to beat inflation, be sure to check out my 5 stocks to beat inflation video for specific tactical approaches to weathering the storm. Today though, I selected 4 stocks to screen for you and show you my process. Those are Coca-Cola, Prudential, AT&T, and IBM. This evaluation will reveal the factors that help a company survive and potentially thrive in an inflationary environment. Each of these 4 have similar storylines. Old school companies with resilient products, they yield a dividend and have underperformed the market as a whole recently. I'll explain why I'm focusing on these 4 metrics. Old school companies, they've been through inflationary times in the past and survived, so their business model is tested. The fact that they have resilient products means that customers are unlikely to stop using them even if prices go up. This means that the business can pass along price increases to maintain their margins and, more importantly, their balance sheets. A strong dividend yield means they've reached a level of maturity that they can pass on profits to investors. When companies make the decision to move towards dividends, this is not done lightly. Usually means they plan to always pay a dividend into the future. And by choosing underperforming companies, I don't have to worry about investors fleeing the stock if earnings multiples start to contract at the macroeconomic level. First, let's start with what feels like an obvious question you might have. Does it sound counterintuitive to look for stocks that have underperformed the market? Are you factoring in that the last decade has been one of historically low inflation? Inflation increased only about 20% during the previous decade. This year, we're seeing 5% jumps monthly. Growth stocks outperformed during the milder inflation of the 2010s, and that's about to revert to the mean. But try not to think of it as the stale debate around growth versus value picks. Think of it instead as a reliable cash flow versus not debate. So Coca-Cola is up first, an American icon that won't be shutting its doors anytime soon. Yields about 3% as a dividend, and as PPI rises, Coke boasts a balance sheet that can nimbly absorb the increases to raw material costs while they raise money through cheap debt. Their A1 credit rating from Moody's ensures they'll be able to borrow at a very affordable rate. This gives them the flexibility to defend their dividend even if their cash reserves do get strained. So run the check. Old school company, resilient product, dividend yield. Okay, so far so good. How about underperforming the market recently? Well, I had a dog and his name was B-I-N-G-O. Bingo, Coca-Cola has underperformed. Take note that none of that analysis involved actually wanting the dividend payout or including the dividend as part of my personal position, because the dividend itself isn't carrying me through inflation. It's helping me determine which companies are resilient. Second iconic stock that I chose to look at, IBM. I was just trying to think of old school brands, Coke and IBM. How do you think I did so far? Let me know in the comments down below. This isn't your parents' IBM. This company is generating income through software and cloud computing operations. Does IBM make a sticky product? I'm about to answer a question with a question. Well, who buys cloud-based services? Answer: companies that need IT buy it. It is part of a backbone of their business model. During tough times, tech companies might cheap out on coffee in the break room or even delay raises, but they aren't going to cancel their cloud solution providers or their relationship with IBM. Run through the screener again. Old school company, resilient product, dividend payer, and underperformed the market during recent years of low inflation? Check, 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 check. It's the inflationary hedge grand slam. 4.36% is a great payout too. Hopefully their Red Hat acquisition generates alpha for those of you already invested. My third pick has been around just as long as IBM and Coke, a true American icon, the telecom behemoth AT&T. Fun fact, their roots go all the way back to 1876, courtesy of Alexander Graham Bell. They generated $170 billion in revenue for 2020. This is not a company on the verge of collapse. They sell a sticky product, cell phone service. What hasn't this company survived in the last 150 years? You think they haven't seen inflation before? Now, a big caveat is that 2020 resulted in a net loss for AT&T. First time that's happened in a decade. But what wasn't unusual about 2020 for any of us? Well, with that in mind, I'll give AT&T a pass on last year's earnings. So let's run through the screener. Old school company? Absolutely. Founded by Alexander Graham Bell. I mean, come on, resilient product? I'm not giving up my cell phone, are you? So yes, resilient. Dividend yield, 7.1%. And has it underperformed the market? Notoriously. AT&T is the poster child for underperforming the market in one hand while sporting a juicy dividend in the other. AT&T is another grand slam for these inflationary times. Notice we're using common sense here. I'm not digging up complex terms from the Fed. There's no calculations involved, no coin flipping, no tea leaf reading. Just know what you're invested in and how those companies perform financially, and you can predict how inflation will affect your holdings going forward. My final analysis of the four, I went with Prudential. Right off the bat, I'll tell you the share price has had strong upward momentum the last 10 months. They're in this basket of insurers and financial companies that have shot up and led the market since Pfizer Monday. Prudential has still underperformed the market on a longer time frame. They have revenue, a good dividend, and name recognition as one of the top insurers in the US. They also posted an out-of-character loss for 2020, but don't expect that to happen again in 2021. Prudential's TV commercials in the 70s told us to get a piece of that rock. Well, it's 2021 and my hand is out. I'm reaching toward that rock. They check all the requirements of stocks ready to ride out inflation. So here are 4 winners that check off all 4 of my common sense metrics to find companies that can ride out inflation. These big dividend payers have a low cost of debt and they are incentivized to keep paying that dividend, which will keep their share price elevated. In fact, the CEO's pay is often depend on the shareholders being happy. So let's take advice from the great philosopher Plato and assume that psychological egoism is a real thing. In case you don't know that term, it's where humans will protect their own welfare first. So let's expect that CEO to protect his investment, and in doing so, he'll protect ours. Let's keep that dividend rolling. As always, thank you for joining, and I will see you on the next one. Okay, well, I hope you've noticed a theme in my videos lately. I'm harping on the impact of inflation. I'm a business owner, so I definitely see inflationary pressure on wages and durable goods like vehicles. Anyway, I'm curious if you guys are seeing inflation in your everyday lives, even if it's just anecdotally. All right, thanks for joining. Bye.